Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
So nice to have you back with us to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from the #1 business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. You can also go to TomWilsonProperties.com and sign up for our weekly newsletter that has a lot of economics information as it applies to real estate. And also, by so doing, you can also get access to our commercial syndications that we offer, which are typically $50,000 a share for large commercial properties that normally only institutional investors can afford to get. Also, a lot of other education information on there. We're big on that. And so is our guest, big on education. And we have with us back again, Bruce Norris today, who is a longtime investor, long-term hold investor, flipper, hard money lender, educator, and originator and host of I Survive charity event. And one of the guy that in 2005, I met, who helped save me over $1 million by telling me that it was time to get out of the market. So he's known as the one of the rock stars here of real estate timing. Bruce, always nice to have you back on the program.
Tom, thanks for having me. I appreciate it very much.
So Bruce, just for maybe the few listeners who haven't have heard you before, just briefly. You got into educating yourself and educating others because you missed a mark decades ago, and you said to yourself, my gosh, no one out there is predicting how to tell when the market shifts, and I don't want to make that mistake again. Tell us a little bit about that.
Well, I started in the business in about 1980, and kind of had a lot of momentum all the way through to 89. I felt like I had a pretty good grasp of how to make a profit on things, and I decided I'd build 7 custom homes in 1989, got done with them in 1990 in June. They happened to be in Palm Springs. I ran a full-page ad to sell those properties. I was so cocky, actually, that we would sell them that I bought a golf cart that held 8 people and a driver, so I could tow people around to see the properties because I knew we'd have a great response. Never got a phone call on that ad, and 2.5 years later, I closed the final escrow on the remaining house by writing a personal check of $62,000 to close what would have been a short sale.
Those are painful times, aren't they?
Yeah, but, I got to say, it's probably the best thing that ever happened to me because it forced me to realize that things change. And it's when we started looking at, in 1995, I had a chance to buy, my son Aaron graduated from high school, and I buy him a Honda Civic for $15,700, and 2 days later buy a house in Riverside for $13,300. And I realized, holy cow, 5 years ago, real estate was the ticket, and now you can give it away and no one wants it. And I just thought, I've got to get a grasp on when that change happens, both directions. And I really looked for somebody that had done that before so I could just read their stuff. And I just found that no one had really done it. And so that was really my goal, was to try to appraise the state of California in advance and know what events made the turns occur.
Isn't it amazing that some things that are clearly so important, you assume there's a lot of information about it, and sometimes there isn't, and you got to go figure it out for yourself?
Well, I can tell you there wasn't, because I looked up every article with the word price in it in every magazine and newspaper for 25 years from 1970 to 95. I mean, if it was there, somebody had written a report, I would have read it for sure. It just wasn't there.
Amazing. By the way, with us today to help co-host and have conversation with Bruce is Richard Smith, my long-term accountant, long-term investor himself, and hard money lender. Richard Smith. Richard, thanks for being on the program with us today and help me interview Bruce.
Thank you, Tom.
So Bruce, from that process, as I recall, and I met you in 2005, and about 2002, I started thinking something's wrong here, and this is a bubble, and I'd been in the market since the 70s, but and seen cycles, but I hadn't seen one that was bubbling that much, and I just had an uncomfortable feeling. Didn't make sense. And I met you, and you put the charts and numbers behind my hunch, and started getting out. And I think that's when Richard, you met Bruce too. We were at about the same time, and by about that time, Bruce, as I recall, some of the metrics that you had learned were that, and were educating us about, were that the affordability index was one of the indicators of when things are about to come down, and inward migration is when they're about to come up. Is that still true today?
You know, affordability is one of the domino charts. If that gets to a level that's too low, to me, there's a series of dominoes that's happened every time I don't want to get in the way of. And so that is the chart, one of the charts that I look at most seriously to see if we're in a dangerous area. And how that came about was just looking at years and years of data, honestly, without an agenda. And that's the most important thing. Whenever I am sitting in an audience listening to somebody else, I want to know the reason the report was written. If it was to support an industry and, make the industry feel good about itself instead of really analyzing what happens, I become very uninterested. I really want to do research that tries to get to the truth, because I have money at risk. You guys have money at risk. And what's the point of kidding ourselves? I want to know what charts matter. And when I see them, and what's interesting, to do it really early, to exit really early, it can be very expensive as well. So in 2002, I bought 93 building lots and dragged my feet and didn't start a project of building them till 2004 intentionally, so I could sort of peek out. And so the warning signs for me weren't in place in 2002 or 3 or 4. They became evident in 2005, and I was already out.
So what is, are there additional metrics that we should be watching in this post-crash market now, in addition to affordability index? And by the way, for our listeners who are not aware, at least in California, and I think it's pretty much true nationally, isn't it, Bruce, that a lot of most of our crashes have happened when affordability index has gotten down to 17%, and in California, the last crash went down to 12%. You might define affordability index for our listeners, Bruce, please.
Yeah, affordability is basically saying that you have a median price of a home in California. Assume that there's a 20% down payment, leaving you an 80% loan balance. You match that with the going interest rate and come up with a payment. What percentage of the households would get a yes answer from a lender? That's the affordability number. So when you get down to 17%, and I didn't think there was any magic to that, except for lots of bad things happen after that. There's a sequence that occurs. So all of a sudden sales stall because the lenders, if they're being honest, and there's lending is legit where people are actually having to qualify. At 17%, there's a lot of people that get finally told no, that want a yes. They want it in really bad. That's how you get to 17% affordability, is there's this emotional push to the end of real estate's price cycle. And then you get to this breaking point that happens to be in California, 17% affordability, and all of a sudden sales stall, prices stall, inventory builds, and because prices stall, everybody that was in default all of a sudden now doesn't have an easy solution. And they go into the foreclosure and through to the trustee sale and back to the lender, and all of a sudden the mix of inventory changes. And when the mix changes, all of a sudden that's when damage starts to happen. When in Riverside and Sacramento, 70% of your comps are an REO sale, well, if you're on the right side of that, it's wonderful because you're buying stuff for 25 cents on the dollar. If you're on the wrong side of that, it's hard to get out. You have to get out in time, or it's really tough, especially the last cycle. Last cycle was an exaggerated time where if you didn't get out right, you probably didn't get out, and that's the toughest part.
People have asked me, Tom, why is this 17% number there? And like you said, there's no magic to it. It's just kind of like fluid dynamics and human psychology. It's like freeway ramps, right? All of a sudden, boom, traffic's moving, then boom, it isn't, right? So you just get this. I think you cross over this not enough critical mass to be enough demand to keep the machine going on when you don't have enough buyers, right?
The simplest thing to do is ask yourself to take a look at the next 2 years of charts of inventory for sale, of foreclosures, of price damage, and see if you would have wanted to stay around. We've only hit affordability 1980, 89, 2005, and figure out what happens 2 years after that, and then go, yeah, I'd love to stick through the 2 years after the next time it hit 17. I doubt it. Because the odds are you're going to have a damage.
Mm-hmm. Okay. And is inward migration still a good metric to follow on telling you when things are about to go back up?
No, and that's what's interesting. That's why most of my money is not in California now, and I know you guys don't have a lot of money here, or the majority of your rentals are not. And what's happened is California is no longer the favored state for in-migration from other states at all.
Right. We
now lose migration. And so that original metric, it was it was still true. And yes, when you have a down cycle, you have improved numbers, but California really is no longer the mecca for people to land here. John Burns, in that really good book that he wrote, Big Shifts Ahead,
yep,
really talked about migrating, and they're heading somewhere else now.
Okay, and so what I was saying is that inward migration is one thing that can tell you where things are going to get better, and you're just indicating, I think, that in California we don't have that inward migration much anymore, right?
That's right. It might improve, but we're missing that big driver of influx of people from the other 49 states. Yep. We don't get it anymore.
We'll talk more about that in just a moment with Bruce Norris, real estate timing expert, longtime investor, educator, hard money lender, and good friend. And we'll be back with Bruce on KDOW AM 1220, the Wall Street Business Network, in just a moment. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
It's nice to have with us today Bruce Norris back on the program, who's a longtime investor, hard money lender, educator. And we have also Richard Smith in studio with us today, helping to co-host our interview and talk with Bruce Norris. So, Bruce, and for those that are listening to this live and who are maybe catching the podcast before September 14 or 16, 2017, Bruce will be here in the Bay Area speaking at SJREI on the Thursday the 14th about Quadrant 4 and what you need to know in this part of the real estate cycle and what to do about it, and an all-day workshop on the 16th on Saturday. So you can go to sjrei.org and sign up for that, and highly recommend it. When Bruce has done some research and has something new to present, I must say that it's always worth listening to indeed. So So, Bruce, let's talk a little bit about what that presentation is going to be about. And I know you've been promoting that in this market cycle and this timing. Of course, we always tell people, those that ask me, what do I think about the market? And I say, well, first of all, the market is thousands of submarkets, and it's local. And not only is it local geographically, but it's local depending on the asset class and the price range within the asset class. And all of those have different cycles. But in general, chat with us, Bruce, about what you're going to be presenting and what Quadrant 4 is all about.
When we put together these studies for the charts to say when the cycles change, it also was a blueprint for us as investors to say, okay, if we see these series of charts, then we should do these types of activities. And Quadrant 4 happens to be a cycle, and we've been in it now for the last, say, 7 years, where you progressively get stronger and stronger gains in prices. And so during that journey, there's things that you can do that are very profitable as investors. First of all, you look to buy directly from people. So you have to have the skills to talk to people. And one of the things we'll do on the Saturday all-day classes, we'll do several role-play negotiations to where you'll get the idea how to talk to people. We'll talk a lot about closes that have worked for me, things that I've said, things that I've observed, that type of thing. We'll make sure everybody knows how to look at charts and say, okay, this is when you look like you're going to go from Quadrant 4 to Quadrant 1. And there's a chapter on the Saturday course, if you get caught holding the bag. So if you don't get out, then what to do. But hopefully that's kind of what we're going to do, is talk about the charts and say, okay, in the business that we're in right now in California, we're in Quadrant 4, this is how most of the money is made. And I hadn't really thought of this, but, I mean, every month we're funding $5 million worth of deals, and that's a blueprint of how those deals are found. Any one of those deals, all you have to do is look at the source. Okay, what did you do? Oh, you had a sign out, a mailer out. You talk to a human being. Why did they sell it below market? You know, you look at a number of those examples, and you kind of get an idea of why this business works in Quadrant 4. Even when things are booming, people are buying things at a discount.
I didn't think about that in your hard money lending business. That is a good resource for you to be a barometer for what's happening in the marketplace, isn't it?
Well, absolutely. As a matter of fact, it usually is from people that have done what we've told them to do. And that we can definitely tell when the source of their deal starts to change. Okay, we're not in Quadrant 4 anymore. When somebody says, yeah, this is an REO purchase, well, we're not in Quadrant 4. You know, we're no into one or number 2. And again, that dictates a very different skill and ability and intention. I mean, and honestly, you know, that's where, if you're going to go into Quadrant 2, which is a down market, you'll be picking inventory that you might want to hold for a very long time and buying it at a very cheap price.
Mm-hmm. Okay. And we've been in Quadrant 4 about how long?
Well, I mean, honestly, about 2012 on, we've been in a market that's been growing stronger. Prior to that, you were just still suffering between 2008, 2011, trying to find some equilibrium.
Okay, we'll be back in a moment with Bruce Norris, a longtime investor and educator. We're going to be asking Bruce about where things are headed, how you can take advantage of the market now. Do we have a recession coming up? What will it look like? So stay with us, and we'll talk some more about that, get some answers from Bruce, get his perspective on that on KDW 1220 AM, the Wall Street Business Network. This is Tom K. Wilson. Stay with us. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Bruce Norris on with us, real estate timing expert and educator. Bruce, can you define just real quickly what Quadrant 1, 2, 3, 4 are?
Quadrant 1 is the pause that happens after a big run in price, and the big run in price we call Quadrant 4. So you go from a booming market to a flat market to a down market, which is Quadrant 2, then a pause, Quadrant 3, back to Quadrant 4 where you go up in price. Quadrant 4 and Quadrant 2 can be the longest quadrants where we're moving in price. The pauses are not insignificant for an investor, but that's where the transformation happens and where your decisions become real important. If you're going to go from Quadrant 4 to 1 and you're holding land,
Yep. Yeah, we that's when you got to be particularly astute, right? People ask me sometimes, how do you know when the peak where the peak is? And I say, well, after it's over. But that's when you really know. But that's not a good time to find out. You want to have some predictions. So follow Bruce.
Well, especially in certain product types.
Yeah,
there's some product types that are okay, but boy, some of them are really not.
Yeah, you would concur, right, that these cycles vary quite a bit depending upon asset class and sub-markets and all that, right?
Oh, yeah. I mean, there's no doubt. I'm looking at the big picture for systemic events. But there's no doubt, let's say, and that's why it's important to know good times are coming, too. So in Quadrant 3, you're dealing with people that are in a bad mood toward real estate. They hate what they have. If you own a building lot for the 5 years before that, you haven't heard from a soul. That's the time to make a call and buy some building lots because you're the only person in the world that's interested. And that's perfect timing before Quadrant 4. You're going to have some holding time. But when we bought those lots in Rosamond, in the middle of nowhere, there was no one else interested in those lots. And in California, we bought lots for $3,000 that ended up holding a property that was worth $280. So we had 1% land cost. That is completely nonsense.
Really takes some guts and maybe other parts of the anatomy to go step up when nobody else wants anything, right?
Yeah, that is true. That's why I have charts. I don't have that kind of guts, but I have pretty good idea that things are going to go the other way once I see a pair of charts.
Yeah, that's where money's made, and it's really tough to do something when nobody else is doing it, isn't it? Huh?
Without charts, it's impossible.
Yeah.
Especially selling. I mean, selling is harder than buying low, honestly. Selling at a peak market is tough because you kind of get a kick out of seeing what just happened to your properties. And then it's over. You know, you've cashed your check and it's just like, oh, it went up some more. You feel kind of bad. But that's why I like charts. It takes the pressure off and makes the decision easier.
Yeah, my listeners know one of my favorite quotes is the Rothschild family saying their wealth was primarily because they sold too soon, over and over again. Right? when they knew they had a profit in there, and boy, during the Quadrant 4, which lasts a long time, boy, it's really easy to get complacent and think that's just going to keep on going forever, right?
Oh, that's definitely true, and it's not just the one-off investor, it's builders. I mean, if you look at a building chart, every time there's a turn, 89, they're building the heck out of houses. 80, they're building the heck out of houses. 05, they're building the most houses ever, and then it's about to crash. And the problem is they're sitting there with daily evidence that they're doing the right thing because everything they build sells. And they don't look at charts that tell you it's going to change so hard, so quickly.
Boy, good lessons, and we'll hear more from Bruce about his predictions coming up and then about I Survived event. And stay with us. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Bruce Norris with us, long-term investor, time investor, hard money lender, educator. Bruce, what is different in this market expansion post the largest crash we've ever had in real estate from prior market expansions? What's different this time?
What's different is the progression of prices has been mild. You have inventory levels that have gone down. You have affordability that's still pretty high. You have interest rates that are, very low. And yet you don't have the super demand from the occupant buyer. And the prices, other than you have areas like San Francisco and San Jose, like what you were saying, there are specific markets for very specific reasons that have gone crazy. But for instance, Riverside, we're still building 80% less homes than we would typically build in a peak. Why? Because our price is still not to where it's profitable for builders to build. And this is after all of this price journey.
Cost of construction is still greater than the cost of a resale per foot.
Obviously, it's interesting. You hear California Association of Realtors talks about we're missing 40,000 houses that we should be having a year. We're short 40,000 houses. Well, trust me, if a builder could build 40,000 houses profitably, he would do it.
Yep.
It's just that simple.
Yep.
He can't. And so that's what's different. I mean, you have markets still like Rosamond, where I was building. They're not building anything. Lancaster, Palmdale, Riverside, San Bernardino, we're really at levels of 20% after all this time. I just looked at some charts this morning. We're building about 75% of the subdivisions that 25% of the subdivisions that we normally are under construction going forward. So even the confidence level saying things will be okay 2 or 3 years from now to build isn't there.
You said a moment ago we're at 20%. What did you mean, 20% of what? 20% of the level of construction that we were in past markets?
Yes, of single-family homes in Riverside.
Yep.
20%. So if we were building 80,000, we're building 16.
Wow. Yep.
And that's after 5 years of progressing, of going up. But we're still that far off the mark. And it's funny because that's why I like charts. You can meet somebody and talk about real estate and say, oh, yeah, we're starting to build everywhere. And that's interesting perspective. You look at a chart and you go, well, it is double from 3 years ago and 80% down from the former peak. So
everything's relative.
I guess that's right. I guess it's whatever news you want to portray. Things are wonderful, except for 80% of the people still don't have a job in construction that do single-family homes.
My favorite story of everything's relative is on one of my first trips to Europe. We're sitting on the tarmac for 4 hours, and I was complaining and whining. And finally, after 4 hours, this gray-haired gentleman next to me said, "Sonny, my first time to Europe, it took me a month in a boat." So everything's relative, right? Took the wind out of my sails. Okay, I got it. Bruce, let's talk just a moment about loans for investors. You saw a niche there and a vacuum of money available for investors, and so you started hard money loans and have done very well with that. What do you have deployed now? $70 million?
Yeah, that's about the number. It's not in a group, if you will, a group investment. If they're all individual trustees held by individual trustee investors, which is unique, by the way. I mean, most people pool money.
Yeah. How many other? Go ahead. I'm sorry.
I was just saying, my problem with pooled money is I wouldn't want to put my money in it.
Right. Sure, because you don't know where it's going, right? Yeah, just like blind, Wilson Investment Properties doesn't do blind funds because we feel most folks would prefer knowing exactly what product and market that money's going into.
Right, and that's exactly right. So you could raise money on a blind pool and then buy something that somebody in the pool would look at and go, "Gosh, I wouldn't have done that."
Yeah,
and that's like a trust deed, So most people never care until they care.
Yep.
So it's working until it doesn't, and all of a sudden you go, "Wow, 80% of our money is in dirt." Uh-oh.
Well, Bruce, you and I had the pleasure of knowing Dr. Doug Duncan for many years. And it was 10 years ago, just about today, that I met him, and then Richard Smith and I had the pleasure of helping to expand the relationships there. And when he was out here, and we said, "Hey, Doug, you kind of didn't the Capitol Hill kind of throw the babies out with the wash here? Yeah, I know how the speculators got the headlines, but there are a lot of us long-term holders that we think are contributing value to society. Why don't you swing the pendulum back and help us out a little bit? And doggone if you didn't take our cause back. And you and I had the pleasure and honor of being invited out 3 times to present to Capitol Hill and Fannie Mae. And we generally think, gosh, the little guy doesn't have any influence. But lo and behold, they're starting to make some moves, aren't they?
They are. And that's, I got to say that he's been a pretty big friend to the investors, to have an audience in front of decision makers. And, you and I may really not have talked about this, but I thought the tone of the last meeting was just way better.
Oh, yeah.
There was some serious conversation and consideration about expanding financing to investors. They were trying to get to the bottom line of how they could get a yes answer from, the public, basically, and how they could pull it off.
Well, when you got 60 folks, you got 60 folks show up and 20 VPs, and the CEO is sitting in the front line asking as many questions as anybody. That's a signal, I think, right?
Yeah, that was fun to be a part of. It really was. And Doug is, he's on the panel and I Survived again, and it's always interesting to hear his take, along with a lot of the other panelists that have expertise in their industry. I get a big kick out of that night. There's no doubt about it.
Yeah, we'll talk about that in just a moment. It's a big ship to turn. Fannie Mae is the largest lender in the world, and by golly, Bruce has played a role in helping to get them to listen and maybe make the investor a good thing again. Stay with us. We'll be back in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
And Bruce Norris with us today, our good friend who's a real estate timing expert and hard money lender and longtime real estate investor and an educator. He loves educating and teaching more than anything else. I love it when heard Bruce one time with supposedly an argument with someone had a different point of view, and Bruce just shut up and listened. And I said, Bruce, you didn't say much about your position. He says, Tom, I'm not interested in being right. I'm just interested in getting it right. So I never forgot that. And that reflects Bruce's true, humble, and objective research and desire to always keep learning and teaching us. Thank you, Bruce, for all that you teach us.
My plan. I got to tell you just a really brief story. I know we got a brief segment, but I actually had a heckler in an audience, and I haven't had one of those in years. Mm-hmm. Most time everybody comes, they know us, and we're kind of beloved.
Yeah.
Well, this guy was a heckler. He was disagreeing with everything I said. It was great fun. It was a ball. I had a ball.
I bet you did. I hope that's on YouTube. Just quickly for everyone, if you're listening to this podcast or live before September 14, 2017, Bruce will be at SJREI for the Thursday evening presentation and the Saturday all-day workshop talking about Quadrant Four, this part of the market timing, what you should do about it. Go to SJREI, San Jose Real Estate Investment Organization, sjrea.org, and you can sign up, and we will be there. We'll have a team there, and and then number 2, before September 22, if you're hearing about it, there are a few seats we can probably get. It's pretty much sold out, but if you get hold of me at TomWilsonProperties.com, I might be able to find you a seat. I Survived, it's 10-year anniversary. It is probably the number one charity event in the country for real estate investors. Dr. Doug Duncan, who goes to about 85, he speaks at about 85 events a year, not including Capitol Hill, says it is his number one favorite event. He'll be on the panel along with some other wonderful folks, and what a wonderful charity and event that Bruce and his wonderful son, Aaron, have put together over the years. Thank you, Bruce, for that gift.
Our pleasure.
And lastly, Bruce, in about a little bit less than a minute here, any parting thoughts about, obviously, Doug says, all expansions end. And this is probably the weakest expansion we've had, recovery rather. How long for the next recession, and what do we do now about it?
I think the next recession, is probably a year away. I feel like the last half of 18 we'll see that. Doug has expressed his opinion on recession, so I'm definitely going to ask him what he thinks is going to happen, and also what's going to happen to interest rates. One of the things that might happen is our industry may get a boost instead of a downturn. If you give us a really ridiculous interest rate for a 6 or 9 month period, and you refi almost half of the loans in America, that can't be bad for our industry.
All right, so we're going to leave it on that note. Bruce, thank you so much for being with us again. We look forward to seeing you coming up here in next week, I guess. Yeah, a couple of weeks. And then also at iSurvive, we'll certainly be there. Go to TomWilsonProperties.com, sign up for our weekly newsletter, and get access to syndications that come up, and all the podcasts that have been on there with Doug Duncan, Bruce Norris, and so forth will be on there. And remember, the only thing that matters is what you do next. Thanks for being with us today. Thank you, Bruce.
All right, thank you.
We'll be right back.